Hey everyone, welcome back to Corporate Decoder, the place where we try and make sense of all the corporate mumbo jumbo so you don't have to. Today we're diving into some financial reports from the Bramshill funds, specifically the Bramshill Income Performance Fund and the BHILL Fund. And let me tell you, there is a lot to unpack here. From how they're investing money to some pretty interesting fee structures. So, what is the big picture? This is a semi-annual report covering the period from April 2025 to September 2025. Think of it as a mid-year checkup for these investment funds. We're going to look at how much money they're managing, where they're putting it, and what kind of returns or costs investors can expect. And don't worry, we'll cut through the jargon and get to what it actually means for your money. We also have a Discord community linked in the description below where we break down these filings in real time, so be sure to join us there. First up, let's talk about the Bramshill Income Performance Fund, or BRMSX as it is known. This fund is a pretty big player managing over $1 billion in assets by the end of September 2025. That is a substantial amount of cash, and it means the fund's decisions can have a real ripple effect. Now, you might be wondering how much it costs to manage all that money. The fund reports paying out over $4.6 million in net advisory fees just in this 6-month period. This is a significant chunk of change, and it is paid to the investment manager, Bramshill Investments Incorporated, for their expertise in picking investments. It is important to remember that these fees directly impact the returns investors see. Looking at the fund's holdings, they've got a pretty diversified portfolio. The top holdings include US Treasury notes and bonds, which are generally considered safe bets, but they also have exposure to things like the iShares 0 to 5 year high yield corporate bond ETF and the iShares preferred and income securities ETF. High yield bonds and preferred stocks can offer higher returns, but they also come with more risk than government bonds. About 40.6% of their assets are in corporate bonds and 17.2% in US Treasury securities. They're also investing a good chunk, 15.8%, in preferred stocks and 15.7% in exchange traded funds. Now let's shift gears to the BHILL Fund, ticker BILKS. This fund is much smaller, managing around $99 million by the end of September 2025. It also has a different strategy aiming for capital appreciation, meaning it is focused on growing the value of the investments. The BHILL Fund is quite interesting because it reports 0 advisory fees. This is because it is designed for specific types of investment programs where the fees are handled differently. Its strategy relies heavily on exchange-traded funds, with a whopping 76.7% of its assets in ETFs and 14.7% in preferred stocks. It is a very different approach compared to the Income Performance Fund. When we look at the actual investments within the BHILL Fund, a big chunk of it, 22.5%, is in the iShares 0 to 5 year high yield corporate bond ETF. This signals a clear focus on riskier, but potentially higher reward corporate debt. Another significant holding is the iShares Preferred and Income Securities ETF at 11%. They also hold the iShares 20+ year Treasury Bond ETF, which can be quite sensitive to interest rate changes. The fund's reliance on ETFs means its performance is closely tied to the performance of those underlying funds. Back to the Bramshill Income Performance Fund, we see a more traditional mix of corporate bonds and US Treasury securities. Within corporate bonds, a notable portion is in the financial sector, with holdings in Bank of America, Citigroup, and JP Chase, among others. This makes sense given the fund's focus on income. They also have significant exposure to the electric utilities sector, which often provides stable dividend payments. Looking at the balance sheets or statements of assets and liabilities for both funds as of the 30th of September 2025, we can see what they own and what they owe. For the Income Fund, its total assets are over $1.14 billion and its liabilities are around $14.6 million. This leaves it with net assets of over $1.127 billion. For the BHILL Fund, it has total assets of about $100.5 million and liabilities of $1.3 million, resulting in net assets of around $99 million. Now, let's talk about performance. For the 6 months ending the 30th of September 2025, the Bramshill Income Performance Fund reported a net increase in net assets from operations of over $34 million. This is a solid performance, driven by both investment income and gains from their investments. The BHILL Fund also saw a net increase in net assets from operations, which was over $2 million for the same period. It is important to remember this fund only started on the 1st of April 2025, so this is just its initial period of reporting, and the results are positive for a new fund. Let's drill down into the per share data for the Bramshill Income Performance Fund's institutional class. For the period ending the 30th of September 2025, the net asset value per S-share was $9.83. The total return for this period was 3.26%. This means an investment of $100 would have grown to approximately $103.26 during this 6-month period after accounting for all expenses and distributions. The expense ratio for this class is 1.08%, which is a pretty standard fee for actively managed funds. For the BHILL fund, the net asset value per S-share was $10.17 at the end of the period. Its total return for its short reporting period was 3.59%. What is really striking here is the expense ratio. Before any reimbursements, it is 0.52%, but after expense reimbursements, it is actually 0.00%. This means the advisor is covering all the operational costs for this fund, which is quite a generous move, especially for a new fund. Digging into the notes to the financial statements, we see some important details about how these funds operate. One key point is their valuation policy. They use generally accepted accounting principles and follow specific rules from the Investment Company Act of 1940. For investments traded on major exchanges, they use readily available market prices. For less liquid investments, they use valuation services or other models to determine fair value. This is crucial because it ensures that the reported values of the fund's assets are as accurate as possible. The funds also engage in derivatives. The income fund, for example, has used futures contracts, options contracts, and swap contracts. These are complex financial instruments. Futures are used to manage interest rate sensitivity, and options can be used for hedging or generating income. Swap contracts like credit default swaps can be used to manage credit risk. While these tools can help manage risk, they also introduce their own set of complexities and potential for loss if not managed carefully. The report mentions that as of the 30th of September 2025, there were no derivative positions held by the income fund, which might indicate a more conservative stance at that specific moment or a change in strategy. When it comes to related party transactions, the most significant is the investment management agreement with Bramshill Investments Incorporated. As we mentioned, the income fund pays an advisory fee, while the BHILL fund's advisory fees are handled through separate agreements, resulting in a 0.00% direct advisory fee for BHILL. The income fund also has an expense cap, meaning the advisor agrees to limit the fund's expenses to a certain percentage of its assets. This is a good sign for investors, as it helps keep management costs in check. The advisor can also recapture waived fees within 3 years, which is a common practice. A really interesting point is who owns these funds. For the income fund, UBS Financial Services Incorporated held about 29% of the shares, and for the BHILL fund, Morgan Stanley held about 100%. This indicates that large financial institutions are holding substantial portions of these funds, likely on behalf of their clients or for their own investment portfolios. Now, no investment is without risk, and these reports are very clear about that. Both funds highlight credit risk, meaning the risk that the companies whose bonds or securities they hold might default on their payments. Interest rate risk is also a big one, especially for fixed income investments, as rising interest rates can decrease the value of existing bonds. The income fund also specifically mentions financial sector risk, acknowledging the inherent volatility and regulatory challenges within the financial industry, where they have a significant portion of their investments. So, what is my take on all of this? The Bramshill Income Performance Fund is a large, established fund with a diversified approach focusing on generating income. Its performance seems solid, but like most actively managed funds, it comes with a notable advisory fee. The BHILL fund, on the other hand, is a newer, smaller fund with a growth-oriented strategy heavily reliant on ETFs. The truly standout feature here is the 0% expense ratio due to the advisor covering costs. This is a huge advantage for investors in BHILL, making it a potentially very attractive option for those seeking capital appreciation with minimal direct costs. Both funds clearly outline their risks, which is good practice. But investors should always do their own research to ensure the fund's strategy aligns with their risk tolerance. Alright, that is our breakdown of the Bramshill Fund's semi-annual reports. What is your take on these numbers and what they signal for the future of these funds? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.